We discussed in our previous video the trading sizes, and now we will discuss how we measure the change in the value of a trading instrument. In FX pairs, the smallest amount of change in a currency pair is called a pip. So should an exchange rate move, that movement is measured in pips. Actually, the word pip, many analysts tend to claim, is an acronym and derives from the words percentage in a percentage. That's why the pip is placed in the fourth decimal place and equals a change of 0.0001. For example, if Euro USD is priced at 1.1110 today and tomorrow is priced at 1.1121, that would mean that the pair moved upwards by 11 pips. Yen crosses, on the other hand, are an exception, and a pip is displayed in only 2 decimal places, hence 1 pip in these crosses equals 0.01. Also, when discussing the pip, we have to mention the fractional pip, or as some traders call it, a pipette, not to be confused with the laboratory instrument. A pipette is a fraction of a pip, actually a tenth of a pip, and is placed on the 5th decimal place to provide more accuracy when calculating profits or losses. However, a pip also has value that can be expressed in monetary terms. But this depends on 3 factors: the currency pair, the exchange rate, and the size of the trade. Let's have a look how these 3 factors interlink and produce the value of a pip in monetary terms. For example, if I trade a full lot in Euro USD, then the change of 1 pip would equal $10. Specifically, if the trader initiates a long position in Euro USD, which is currently trading at 1.11 and then moves up to 1.12, that would mean that the pair moved upwards by 100 pips. And at the same time, the trader would have won $1,000. Why? Because my position was of a size of 100,000 euros, and the exchange rate went up by 0.01, which is calculated by subtracting 1.11 from 1.12, equaling 0.01, or if you prefer, 100 pips. Therefore, my profit would be equal to the position size times the change of the exchange rate. For example, 100,000 times 0.01 would equal $1,000. Hence, my profit equals $1,000. And given that the movement of the pair was of 100 pips, that would mean that each pip of Euro USD's movement equals $10, which is calculated by dividing the $1,000 of profit by 100 pips. Note how the position size is mentioned in the base currency, yet the pip value is mentioned in the variable currency. Hence, if we put it in an equation, that would be pip value equals pip size times position size, and for each pip of a full lot of Euro USD, that would be 100,000 euros times 0.0001 equals $10. If I want to convert the pip value back to the base currency, then I only have to divide the pip value by the current exchange rate of the preferred trading instrument. This will mean that pip value equals the pip size times by the position size divided by the exchange rate. For example, if my account is in pounds and I want to know the pip value in pounds, I change the dollar pip value using the GBP USD rate. So for 1 lot of GBP USD, it would be $10 by the current exchange rate of GBP USD. If you make a couple of repetitions with different exchange rates, it will enable you to make the calculations of the change in an exchange rate in pips. Please note that pips apply only in the FX market. The change in value of stocks, gold, and oil are measured in dollars and cents, while the change in the value of indexes, especially for shares, is measured in ticks. In the next video, we will discuss what kind of orders there are for a trader to start trading.